A call option is a financial contract that gives the holder, buyer, the right, but not the obligation, to purchase an underlying asset, such as a stock, commodity, or currency, at a predetermined price, strike price, within a specified time period. The seller of the call option, also known as the writer, is obligated to sell the underlying asset at the predetermined price if the buyer decides to exercise their option. Call options are often used as a way to speculate on the potential increase in the value of the underlying asset, without having to buy it outright. For example, if an investor believes that a stock's price will rise in the near future, they might purchase a call option on that stock at a lower strike price. If the stock's price does indeed rise above the strike price, the buyer can exercise the option and purchase the stock at the lower price, then sell it at the higher market price for a profit. Call options can also be used as a hedging tool to protect against potential losses in a long position. For example, if an investor holds a large amount of stock in a particular company, they might purchase a call option as a form of insurance against a potential decline in the stock's price. If the stock does decline, the investor can exercise the option and sell the stock at the higher strike price, limiting their losses. Although call options can offer the potential for significant profits, there are also several risks to consider when buying a call option. Time decay. As time passes, the value of the call option can decrease, especially if the underlying asset's price doesn't increase as anticipated. This means that the buyer can lose money even if the price of the underlying asset does not decline. Volatility risk. The price of the underlying asset can be volatile, meaning it can move up or down quickly and unpredictably. This volatility can increase the risk of loss for the buyer of the call option. Strike price risk. If the price of the underlying asset does not increase above the strike price by the expiration date of the option, the buyer of the call option may lose their entire investment. Counterparty risk. Call options are often traded over the counter, which means that the buyer is exposed to the risk that the seller, writer, of the option may not fulfill their obligations to sell the underlying asset at the strike price if the option is exercised. Liquidity risk. If there is limited trading activity in the call option market, it may be difficult for the buyer to find a buyer or seller for their option, which can make it difficult to execute trades and may result in losses. Trading fees. Trading fees, including commissions and other transaction costs, can reduce the potential profits from call option trades. It's important to carefully consider these risks before buying a call option and to have a clear understanding of how the option works and how it fits into your overall investment strategy. Thank you for watching and see you on the next episode.